Ever heard the terms spot trading and margin trading on Binance and wondered what they actually mean? If you're just getting started, it can sound intimidating, but there is no need to panic. In this video, I'll break down the difference between spot and margin trading on Binance, show you how to access both, and help you decide when and why to use each. Greetings everyone, and here's famous meeting Dark Candle. Let's start now with the spot trading in Binance. This is the simplest way to trade crypto. You buy a coin at a current market price and it's instantly added to your wallet. No borrowing, no leverage, just a straightforward buying and selling. For example, you can buy $100 worth of Bitcoin and it's right away in your wallet. To access it, go to the top menu in Binance and click on Trade. Here, Spot. By clicking on Spot, it brings you a full trading interface with the chart in the center. As you can see right now, order book on the left and trading panel at the bottom. There are different orders type. The first one is market order. Here. Market order is an order which buys at the current price instantly. Limit order in the left one is when you set the price that you're willing to buy or to sell at. And the third one will be stop limit or stop market. Both are for risk management, like setting automatic buy or sell triggers. Now, this was about a spot trading, and let's go to margin trading. By going to trade again in the top menu and clicking on margin. Here's where things get more advanced. Margin trading lets you borrow funds from Binance to trade more than you own. This means that you can potentially earn more, but also risk more. For example, if you have $100, you might borrow another $200 and trade with $300 total. That's 3 times leverage. To enter margin, as I told you, you click on trade and go to margin bar here, and it'll bring you this chart, which adds margin specific indicators even. The first time you use it, you'll need to enable your margin account and transfer funds into it. You can then choose isolated or cross margins. If I scroll down a little bit more, here are them. Isolated and cross. Cross is when all your margin balances are shared and can be used to cover losses, but isolated is only when the funds in a single trade are at risk. Binance also offers different leverages levels depending on the pair, usually between 3 times to 10 times. Be very cautious with this. While leverage can increase profits, it also increases losses just as fast. A 10% move in price can liquidate your position if you're over leveraged. So you gotta be very cautious about this one. And about managing risk, always use stop loss orders and never risk more than you're willing to lose. Margin trading isn't gambling. It's a tool for experienced traders who manage risk strictly. If you're unsure about that, start small or stick to a spot until you're confident to do these margin trades. Now, let's go visual tour and do a quick visual recap. Spot trading was buying with your own funds, while margin trading was borrowing funds for more exposure. In both views, you'll see candlestick charts, as you can see right here, order types and trade history, but margin will show a liquidation price, borrowed amount, and interest rate. I talked about interest rates, so let me tell you that there are fees and interests in Binance. The spot trading fees are low, usually around 0.1%, I assume. But in margin trading, you'll pay the same fee plus interest on the borrowed amount. Interest is charged hourly, so holding long-term can be costly if you're not actively trading. And that's your crash course on spot and margin trading in Binance. If you're just starting out, stick with spot trading to learn the ropes. As you grow the confidence and strategy, margin becomes a powerful tool if used wisely. thanks for watching this video and keep up till the next one.